We are looking at Nvidia stock, ticker NVDA, which is currently trading at $201.33. That is a significant drop, down $5.55 or 2.68% so far in today's session. And that price, that red arrow, is the entire story right now. It immediately creates a conflict. The expectation for this company, a name that has become almost synonymous with the entire artificial intelligence sector, is perpetual, unstoppable growth. This is the company that just weeks ago, as reported, became the first in history to cross the $5 trillion market capitalization threshold. This is a valuation that dwarfs the entire economies of most nations. And yet, here it is on a random Tuesday, shedding billions in value like it's nothing. This is the reality of the market, and it's where most people get confused. They see the 5 trillion headline, but they feel the 3% drop. The immediate reflexive question is, what's broken? Is this the beginning of the end, or is it just another Tuesday? The truth, as always, is far more complex. This isn't just noise, it's the sound of a market wrestling with an almost unbelievable valuation. Let's establish the common ground, the story everyone knows. The expectation is that Nvidia is the primary beneficiary, the one true picks and shovels play for the entire AI build-out. Every time a major tech company, a government, or a startup wants to build a large language model, they need Nvidia's hardware. They need the H100s, the Blackwell B200s, and the upcoming Rubin platform. The company's recent GTC conference in Washington, D.C. wasn't just a product showcase, it was a victory lap. Management disclosed that they have visibility right now into $500 billion in cumulative revenue for just their Blackwell and Rubin products heading into 2025 and 2026. That number is staggering. It's so large it's difficult to contextualize. This has led to a situation where, according to the latest figures from John Petty Research, Nvidia controls an almost unbelievable 94% of the discrete graphics card market. Its competition, AMD and Intel, are so far behind they're almost rounding to zero in this high-end AI space. This dominance is why, when you look at Nvidia stock, you're not comparing it to a competitor. You're comparing it to itself. It has joined the ranks of Apple stock and Microsoft in a club of its own. This narrative is why virtually every analyst on Wall Street remains steadfastly bullish, even in the face of today's drop. Just today, Jefferies raised its price target to $240, maintaining a buy rating, citing the scramble to secure AI compute. Yesterday, Goldman Sachs reiterated its buy with a $240 target. Loop Capital is even higher with a $350 target. Rosenblatt is at $240, B of A at $275. Of 66 analysts covering the stock, the overwhelming majority rated a buy. For anyone doing self-investing or using investing sites for online investment, the signal seems clear. Buy, buy, buy. Whether you're in an individual brokerage account or looking at Fidelity ETFs and Fidelity mutual funds, your portfolio is likely exposed to this name, perhaps even through automated systems like Schwab Intelligent Portfolios. But this is where we must challenge the expectation. This is where the reality of the market kicks in, and it's why we're seeing that 2.68% drop today. When a stock is priced for this level of absolute multi-year perfection, any counter-narrative, any whiff of risk creates significant volatility. And make no mistake, the risks are piling up. The first and most obvious one is valuation. That 5 trillion market cap is not just a number, it's a burden. It implies that the company will not only meet that $500 billion visibility, but exceed it and then continue to grow at a blistering pace for years to come. This is why famed investor Michael Burry of the Big Short fame has reportedly taken out new bearish positions against Nvidia. He's not betting that the company will fail, he's betting that the stock price has outrun the fundamentals. He's betting that this AI bubble talk is more than just talk. This creates tension for everyone, from the day trader on the Robinhood app looking at Robinhood stock trading to the long-term holder managing their Fidelity IRAs. The second major risk is geopolitical. A significant portion of Nvidia's growth narrative has been tied to global sales, including to China. However, U.S. export controls have been a constant headache. The company had to create specific, less powerful chips like the H20 for the Chinese market, but even those have faced restrictions. We saw in its second quarter fiscal 2026 report that there were no H20 sales to China-based customers. While the company is finding other markets, like the massive sovereign AI deals in the Middle East, any new escalation in trade tensions between Washington and Beijing directly threatens Nvidia's revenue stream. This isn't a simple business problem, it's a complex diplomatic one that the company has to navigate. Then there's the reality of the recent news cycle, which has been nothing short of spectacular, but also sets an impossibly high bar. Just last week, Nvidia and Oracle announced a landmark collaboration to build the U.S. Department of Energy's largest AI supercomputer, Solstice, which will be powered by a record-breaking 100,000 Nvidia Blackwell GPUs. This is on top of another system, Equinox, with 10,000 GPUs. They also just announced a deep partnership with Samsung to build a new AI factory, integrating 50,000 Nvidia GPUs directly into the chip manufacturing process using Nvidia's Omniverse for digital twins to optimize the fab. Foxconn is doing the same, building a new Houston factory for AI servers that will be one of the first to deploy humanoid robots built on Nvidia's Isaac platform. This is the core of the problem. The expectation is that Nvidia will not only continue to sell chips, but will also become the operating system for the next generation of manufacturing, robotics, and scientific discovery. This is what you're buying. You're not just buying a semiconductor company, you're buying a piece of the future. But the reality is that today it's a stock trading on a screen and it's down almost 3%. This volatility is why many active traders prefer platforms like Interactive Brokers, using the Interactive Brokers trading platform to manage complex risk and fee structures, which are critical when trading a high-priced stock like this. Meanwhile, newer investors might be using SoFi Invest for their SoFi investing, perhaps even using SoFi Active Investing to try and time these dips. Even a SoFi robo-advisor is going to be buying into this tech-heavy landscape. So what does the company actually do? For all this talk, it's important to remember the fundamentals. Nvidia operates in two main segments. The first is graphics, which includes the iconic GeForce GPUs for gaming. This was its original business, and it's still a powerhouse, but it's no longer the main story. The main story is the second segment, compute and networking. This is the data center business. This is where the AI chips, the H100s and B200s live. This segment's revenue has been explosive. In the second quarter of fiscal 2026, reported in August, this segment alone brought in $41.1 billion, a 56% increase from the year before. The company has transformed itself from a high-end gaming company into the single most critical hardware provider for the entire AI infrastructure. Its CUDA software platform created a deep, sticky ecosystem that competitors have found almost impossible to break. This is why it has more in common with Apple stock's ecosystem strategy than with a traditional chip maker. This brings us to the future, and specifically to the most important date on the calendar for Nvidia stockholders, November 19th. That is when the company is scheduled to report its third quarter fiscal 2026 earnings after the market closes. This is the ultimate test of the expectation versus reality framework. The consensus EPS forecast, according to Zacks, is $1.17 per share. The market will be listening for two things. First, does it beat that 1.17 number, and by how much? Second, and far more importantly, what is the guidance for the fourth quarter and the full year? Will they reaffirm that $500 billion visibility? Will they talk about the ramp-up of Blackwell? Or will they mention supply chain issues, softening demand from any one hyperscaler, or new geopolitical headwinds? This earnings report will be the catalyst that either justifies the $5 trillion valuation and sends the stock roaring back up, or it will be the pin that pricks the balloon, confirming the fears of bears like Michael Burry. For anyone holding this stock, whether in a Fidelity brokerage account, as Robinhood fractional shares, or on the Fidelity mobile app, November 19th is the day of reckoning. This is a good moment to ask for your input. With earnings coming